All right. Good morning, everybody. Appreciate you joining us here today. My name is David Perrin. I'm the Senior Vice President at Hunter Hotel Investment Conference. I just want to say thank you all for being at the conference, supporting the conference throughout the years. We couldn't put this on without you, so thank you all for being here. Got a great group of panelists today. I think we can walk through some introductions, and we'll get started from there.
Matt Welch, I'm with Rockbridge. I'm Managing Director on the investment team. I've been there for 15 years.
Amit Sripathi, Chief Development Officer at Wyndham Hotels and Resorts. I've been there about 4 years.
Hi, I'm Colin Carroll with Apple Hospitality REIT. I've been in the industry for a couple of decades now and been with Apple for about 5 years.
Hi everyone, Joe Delasanti, Chief Investment Officer for MCR. We're an owner-operator with plus or minus 150 hotels all across the U.S. and we've been in business for 20 years and I've been there for half of them.
Awesome. I've been at Hunter, I was counting this morning, next year will be my 15th hotel conference that I've been a part of Hunter with. And
Good run.
It's been a good run. Previously, before Lee took over kind of the MC duties, his dad Bob would always jump on stage to start, and we were kind of talking about this in our pre-call before the conference. Every year, no matter what, Bob would ask, "What inning are we in?" We were talking today, or on our conference, and I think it might have been Nelson, and he said, "I don't know what inning we're in. I don't even know if we're playing baseball anymore." And I won't make you answer what inning we're in. I think my answer is, at least in my circle, I think it's kind of like a game of cricket. I don't know the rules, and the games can last for days. And so, don't tell me what inning you're in, what sport we're even playing. But given everything we've seen over the last 5 years, COVID, rates, global war, election, tariffs, DOGE, kind of talk through how with you and your team, how your company is uniquely structured and how you're navigating kind of these markets. And Amit, I think we can maybe start with you.
Sure, it's a pleasure to be here. The lodging industry, I think all the things you mentioned, I'm not going to repeat them, but even before that, what we've seen is we've come out stronger every single time we've come out of it. RevPAR has been higher, and there's no reason to doubt that won't be the case for whatever cycle we go through. We're incredibly bullish about the state of the lodging industry. Of course, there's near-term turmoil. There's a lot of things owners, brands, developers are facing, but we think the fundamentals are there. We think that it is still a great business and a sector within the real estate industry that allows you to hedge against inflation, that allows you to capitalize on things that are trends within your market. So we remain, we're the world's largest franchisor, over 9,000 hotels, and we haven't really changed anything within that. Our commitment's always owner first, and we always try to do what's right for the owner, whether it was before COVID or after COVID, and that's really what we're going to continue to do.
Joe?
No comment. No. Look, it's you talk about like games or sports, whatever. We have someone in the White House now that basically like reset the rules. So like there isn't a game where like he's playing games with us. That's for sure.
Yeah.
But I think like look fundamentally like the backdrop is right. Like long term, if you just think about like the travel industry, 50 billion people get on a plane a year. Like that's going to 100 billion over like the next like 30, 40, 50 years. That trend is intact. If you look at the U.S., where we're investors, the population of the U.S. has doubled like every 40 to 50 years. You can't really say that about like most other countries like across the globe. So fundamentally, we're very bullish on travel over like the medium term, the long term, the supply demand fundamentals, the new supply of which there's virtually none for the next like 3, 4, 5 years. It's historically been 2%. It's kind of tracking towards 1%. So the trends are intact. What are we doing to kind of like play offense now is just like look for attractive opportunities and pull levers that we previously thought were unavailable. We're getting some incentives from brands. We did a deal with Hyatt, call it like in the end of like last year, where there was some key money and seller financing and other kind of like franchise fees ramps. You got to have a lot of conviction. You got to put your nose up. It's going to be a turbulent like 12 or 18 months, but I think if you get through that, the long term over the next cycle is pretty promising.
What's the mantra at Rockbridge today?
Yeah, feel very similar. One thing Joe mentioned that I think is definitely going to be a tailwind in the short and medium term is just the lack of supply. And anyone that's looked at a construction deal knows how hard it is to pencil on those and just the lack of financing. And so I do think that's a big tailwind. It's always market by market and sometimes street corner by street corner, but that's something we're really tracking. But generally, transactions have been very tough. All markets hate uncertainty, and we've had lots of uncertainty. Now, of any macro business, hospitality always has uncertainty, so we're as good as anyone to deal with it. But just the things we're tracking are not overly dissimilar from pre-COVID and post-COVID. It's cost of capital is high, leverage levels are low, CapEx has been a big issue across all the deals. I mean, some of these hotels haven't seen capital in 5, 6, 7, 8 years, and so that's coming to do. The brands are taking these transactions as opportunities to kind of reset that, which I think is probably the right intuition. But it just makes all these harder. And then everything in the P&L from top line to bottom line is under strain, taxes, insurance, all of that. So I think having that conviction that Joe mentioned is critical to what we're focused on, and just finding ways to piece deals together, lead with the real estate first, and we continue to be very bullish on what the kind of short and medium term set of the hospitality investment cycle looks like, but it doesn't mean it's going to be easy.
No, it's call it hand-to-hand combat
Yes,
today.
well said.
Colin, public company, lots to think about and navigate. What's going on with Apple today?
Yeah, I mean, back to the original question about what inning are we in, I agree. The hotel cycle used to be a lot more conjoined together, across the industry, but now we're in this period where you've got a bifurcation of different markets and it's always been a market game, but there's so much of a difference in how some markets have recovered versus others. And so, a lot of leisure markets today are well into their bullpens at this point, from a baseball perspective, and probably playing a different sport, as you alluded to. Whereas, a lot of urban markets started to really see momentum last year and, continue to be on that trajectory now. So, you saw group return in full force last year. And that's something we tried to be more in tune to and look at some opportunities that fit that mold and did that. From our perspective, what we try to do is be flexible. And so we're a low leverage shop, and that gives us the flexibility to stick to our strategy long term, like you said, being convicted in what you're doing. And so that's really how we think about it, is maintaining the flexibility to keep doing what we want to do.
Yeah. Colin, let's stay with you too. I think you look at the last couple of years, transaction deal flow has been down the last 2 years. We're bullish on 25. We'll see what that turns out. And this is coming off of 21, 22, where deal flow, everything was aligned. Bid ask was aligned. Historic deal levels were being made in 2021, 2022. When I look back at your guys' activity at the time, I think you were kind of waiting, seeing, watching the market, seeing a lot of the fervor that was going on, not doing a ton at that time. But over the last couple of years, you've been finding ways to get deals done. So when we're saying cutting-edge deal structures, how have you looked at the last 4 years transactionally within your company, and what have you been able to get done over the last couple?
Yeah, we've been very acquisitive since the pandemic. Bought 22 hotels, circa $1 billion in value in that time, and tried to diversify into different markets. I mean, we have 220 hotels. We're selling one today, so down to 219. I can't even remember if we dropped down a state today, but we're in 37 states, and try to maintain that geographic diversity. Like I said, one of the things we did with some of the deals we've done over the last year, we really targeted Vegas and wanted to be in that market, a market that's had a very strong group resurgence there. And so we did a deal there at the end of 2023, and then did the same thing in DC last year. Certainly a lot of noise, as you alluded to, in the market over the last 6 weeks, but 23 and 24, and January were very strong in DC. So those are two examples of things we've done recently.
Yeah. Joe,
Flexibility is like the key word here that like you alluded to before. You don't know what the opportunity is going to be.
Right.
In 2018, like 2019, like we could buy a hotel at a 7.5 cap. We could debate like whether or not the cap rate was appropriate. We could put
not even one hotel portfolios.
yeah, and you put cheap debt on it, and like the math just like kind of like worked. That math has like basically like gone out the window. So what we're trying to do is like stay open-minded like to the opportunities. We look at Apple REIT stock. We look at Summit stock. I don't know why Colin would go out and buy a hotel at an 8 cap today because his stock trades at like a 9.5 cap. Like it's a phenomenal deal. What like $160 a door for $130 like RevPAR like portfolio across the U.S. That pays me a 7% dividend yield too.
No comment.
It's amazing.
We weren't supposed to go there.
But like that, we're also like playing in kind of like the mezz space, not to be like loan to own, but you have the opportunity to own SOFR plus 750 or 800 on your capital. You put a little bit of like leverage on your position, and you can make a 15% return without really like getting out of bed. So you just have to be a little more nimble because like the deal today isn't necessarily the deal that you did like 6 or 7 years ago.
Yeah. I mean, you guys have pivoted a ton. I mean,
Yeah.
It was select service, big portfolios, aggregate,
Yeah.
manage, separated yourself a little bit through management.
Well,
But now you're
yes.
jumping on a plane to London later.
To go
looking
check
at
out
big
a
full service hotels.
giant antenna that we bought in the middle of the city, which is another story.
Maybe give us a story, like
What?
a deal last year.
Yeah,
How
we'll
did
save
you
that
get?
for-
How
Let's
did
save
you
that
get
for
there?
minute one. But I think the other thing is like a focus on operations.
Yeah.
The operating environment over the next like few years is going to be tough. RevPAR growth, like we can debate it market by market, but it's going to be muted. Like broadly speaking, RevPAR tracks GDP, and I think like expectations aren't that that's growing like a weed over the next couple of years. So we're focused on the deal on the execution side and being flexible and nimble, and not just buying a Hampton like we did 5 years ago,
Right.
and then also like really managing the P&L, because like what you can do in the middle there, like if you can figure out ways to be more efficient, like from an A&G standpoint or from a room standpoint, or utilize the technology that's available to you. I'm not saying AI, I think that's an overused term, but there are ways to be a more efficient operator, carve overtime and all this stuff out of your P&L, and really drive more margin.
Yeah.
And a couple of things that he said, I think having that flexibility and really focusing on the capital structure and how you're capitalized and ensuring you have time to execute on the business plan, I think is very critical. And then it's just a good reminder of it all starts at the ground level, and that's your operator and truly the boots on the ground and down to the GM. And you have to get the right team. It's just more important than ever with the access to information. The consumer has a lot of the cards here, and so if you don't have the right team on the ground, you could set up the best deal and do the best renovation, but if the valet guy is a jerk, the guest isn't happy.
First impression? Yeah.
Yeah,
First
exactly,
impression somebody has.
exactly. And it's hard to control from the desk, and so you just have to really drive into that and make sure you have the right team and that they're focused day to day. How the business comes in is so critical right now too, and just like ensuring that you've got the right channels and the right right levers pulled as that business comes in is just so key to set that up.
And you guys can work across the capital stack. You can buy hotels, you can lend, you can do mezz. What have you guys been more active in today?
I think it's
Why?
that flexibility, and kind of always thought about it as like try to zig when others zag a little bit. Never perfect, but all of it should start at the baseline hotel and underwrite the hotel, and then you should be able to price where you sit in that risk curve, accordingly. And so really nothing changes on kind of where we sit. Underwriting and execution is still the same. It just, we try not to force our capital where it shouldn't be, and as long as we're getting paid for the spot at the curve we sit in, we're happy. And so we kind of do it all, at any given point, and it's not a menu you can just order up a transaction. It's tough, but we're always out there looking for interesting things. I mean, certainly everyone's kind of surged into that, hey, I can get paid mid-teens IRR for not getting out of bed in the morning. That sounds nice. They're hard to find, but I think those are really interesting opportunities, especially when all of that comes together with like the right capital structure, right partner, right operator, right brand, right asset, right market, right street corner. Like all of those things have to come together, and there are a lot of those deals out there.
Yeah.
So we've been doing them all, and kind of any given day, we're focused on all of it. But as long as it starts at the asset level and the real estate leads, like we usually generally have good results.
I call what Matt
The
does
transaction
dequity.
volume. Go ahead.
I was gonna say, I call what Matt does dequity. If you guys
Dequity.
familiar with this highly technical term, it's basically like this is gonna be like an interesting environment. The proliferation of like private credit has exploded. Private credit was like a $500 billion market like pretty much 5 years ago. There's $2 trillion of like AUM in that space today. It's everywhere. Like there are institutional players that are doing it and doing it well. KSLs, Blue Owls, like Sixth Streets of the world, Rockbridge, like in like different scale, but like different players doing it well. But there are a lot of shops originating 70% LTV. We can all debate what V is. At 1 times like debt service coverage ratios or 9% debt yields. And like hotels are an operating business. You go from a 1 cover to 0.75 like
It's
pretty
really
darn
tight
fast. And that debt deal that you did at 70% is really kind of like 110. So I think there's going to be like a lot of opportunities in that space. Like, over the career. Sorry, I didn't mean to cut you off.
No. I was just going to say, I mean, the transaction volume, like you said, it's down, but it doesn't necessarily paint the full picture of kind of what's happening in the industry. There's
Right.
a lot more conversion activity. There's a lot more recapitalizations that are taking place. So there is still activity where ownership is within the same owner. They may be repositioning the asset, and we talked earlier about flexibility, and when you have a fixed renovation cycle and you're doing that, it may not necessarily make sense for that asset in that market there. So we've actually had great activity in the last couple of years, even when transaction volume was down, because our brands, when an owner is looking at ROI, it's about making sure that there's a value associated with it, not just the guest experience is paramount. We obviously want to make sure they have the right guest experience, because otherwise you're not going to get people into it. The first impression does matter, but it's also making sure that you're doing things because there is an ROI associated with it. And then on the debt structures, and capital is hard, especially for new construction hotels. And there have been several alternative vehicles that have come up, and they're all looking for the same thing. It's like when debt was really cheap, you could make any hotel work at 3%, but the fundamental of a hotel is you're supposed to have multiple demand generators, right? You can't just rely on compression. You can't just rely on group. So as long as you have you find you've got multiple demand generators, yes, you may not be getting the same amount of equity. You have to put in a lot more equity today, but over time that asset should do well. You will be able to refinance it. You will be able to get out and do that. And we're also working closely with our owners to help support them on the financing side, including talking to some of the alternative private funds to get that when the local banks may be reluctant to get up to 70 or 75% LTV.
Maybe dig into that a little bit further. How are you filling that stack, or what does that look like? Is that more of a fee relief perspective or additional proceeds? How does that deal actually get done?
It's a combination of all. We obviously, we have multiple tools at our disposal. Sometimes we do use key money. Sometimes it could be fee ramp. It could be in a lot of this, like in this instances, it's really resources, right? To help them talk to lenders, to go out and educating some of the lenders who may have not done business about why, especially if it's a new brand that you're building, about the performance of that brand, how that's doing, to help the lenders, and also bringing in some lenders, whether we're leveraging our credit or something we do on in the back end, to get you a little bit more proceeds than you'd be able to get by yourself. And that I think not just us, a lot of the brands are doing that as well, because we want to be able to, that supply is historically low, and as you're looking several years out, there is a need for different products.
Joe, as you're looking at live deals today, how are the conversations with banks? How's that conversation evolving? What metrics today they're looking for? Raising capital, what's kind of the bogey that everyone needs to meet today?
A lot to unpack there.
Take your time.
All the dequity jokes aside, debt is actually very available. If you look at just like hotel loan origination volume, it's like $50 billion, like kind of like pre-COVID or in a good year. It's pretty much at that level today. You don't see like Bank of America or Wells Fargo or all these groups like originating quote unquote like real estate loans, but they're actually still involved in the market because a lot of these private credit guys, they originate the loan and then the bank goes and finances like the note on note. So they're not the direct commercial real estate lender, but they have this stuff on their books. It's not a real estate loan anymore. It's a commercial loan. So the market's still healthy. The CMBS markets have come back. There are actually a lot of avenues like for debt, and spreads are getting a lot cheaper. We did a loan with TPG 2 years ago at what I'll call like the worst time to finance a hotel at SOFR plus 550. We ate like the worst terms imaginable. Like that same fund, it's like a credit shop. They're like in it to make like a pretty penny. They're originating loans at SOFR plus like 350 to 375, like term sheets now. So spreads are meaningfully better. That's because their leverage is getting cheaper from like Bank of America and Wells Fargo coming back. So I think the capital is out there on the debt side, which is helpful. We just bought 2 Residence Inns, financed them with BMO Harris Bank at SOFR plus 280. Like that's pretty good.
Yeah.
So debt's out there. Look, I will say on the equity side, raising capital is like quite tough.
Right.
Like you have to
Because they're looking at other asset classes, because
well, that and you have to have like a natural churn, right? Like Bank of America originated new real estate loans because they got paid off on their other real estate loans, so they had capital to put to work.
Right.
If you look at it from like an equity perspective and you're an investor, you're sitting there and saying, hey, I haven't really gotten the distributions from real estate that I expected over the last like 2 or 3 years. There hasn't really been that much like transaction volume, so there hasn't been any disposition proceeds. And guess what? Interest is basically eating up all the free cash flow, so you're not getting the operating distributions. So finding like that individual that has fresh capital to put to work is tough. We have good relationships with longstanding capital partners, and we've done a nice job, but I think you've got to see more of like a cycle flow on like transactions happening, distributions coming to kind of like get the equity going again.
right. We've talked a lot about buying. All of you own hotels as well, and a lot of hotels. A lot of people in here probably own similar amounts, less, 5, 10, but always thinking about buying, always thinking about selling. As you're looking at your own portfolio, and you're looking at culling, you're looking at returning capital, distributions, all of that, how are you picking assets, winners or losers, to look at for disposition? Matt?
Yeah, happy to go first. I mean, I think churn is the right word, honestly, is these investors, they're not getting capital back from anywhere, right? And so it's not just hospitality.
It's oftentimes being asked for more.
Correct. And so trying to focus, and at the same time, we don't want to sell an asset at a discount, and we want to get max value, and in many cases, cash flow might be growing, but cap rates also rising, and so you're kind of treading water a little bit, and as Joe said, the lender is soaking up all the free cash flow. So it's really tricky to know kind of when and how to go to market on these assets in the portfolio. We don't really think about it as like culling a little bit. It's just each one has its own story. We generally go in and try to capitalize them right from a CapEx standpoint, and so which gives you the freedom to execute the business plan, even if it takes a little bit longer. And the second you ignore that elevator at closing, that's okay, it's 20 years old, but I think we can make it. And then all of a sudden your business plan extends and now you're in year 6 and that elevator is 26 years old, it's got to go. And then you get forced to that decision. And so we really try to be disciplined on the front end so that we can be opportunistic on the back end or anywhere in between. And so, but it's very difficult to know like when is that pivot point that an asset needs to transact. And I think, I can't remember, Colin, you might have mentioned it, there's lots of different transactions happening, outside of just a disposition, whether call it a recap or an infusion of capital to buy time and try to get investors' capital back, but also continue to harvest the upside. So it's a delicate dance, and you got to be ready. But I think if you set the deal up from the origination and have flexible capital and be thoughtful on how you're creating capital solutions, you can kind of work your way to the right spot.
Colin, how does Apple look at that? Kind of always buying, always selling. How are you?
We're always doing both. Historically, we had not sold as many individual assets or even smaller portfolios because when Apple was a non-traded REIT platform, we could sell entire REITs to specific buyers and had done that some historically. So we're now getting into more of the transactional mode of buying and selling individual assets in smaller portfolios. For us, we want to, I come back to flexibility. We all have capital requirements in any hotel owner, and so we're trying to look at those long term and figure out, what markets are we better off investing in from a capital standpoint. And so when we find those lower growth markets and also high CapEx needs, that pings our radar of something that's likely to dispose of. And so within the last year and a couple of months, we've sold 8 hotels. There was 1 two-pack, but mostly individual transactions. And we're finding attractive cap rates on those deals.
Absolutely.
Because there's a lot of people, chasing sub $20 million-ish type transactions right now. So that's where we've focused today, and then going and trying to redeploy those proceeds into higher growth markets in younger assets with lower CapEx needs. It sounds really simple. There's a lot of sausage making in the middle of that process, but that's what we're trying to do.
We'll be net sellers, I think, in the next 12 to 24 months. It's what we're looking at today is here's the equation. You could sell a hotel at an 8 or an 8.5 cap, or you could go finance it at sometimes a 9 or a 9.5.
Right.
So if I'm gonna go play that game, is it gonna be worth it to stay in the asset for the next 5 years? And the answer is it's kind of probably not.
Right.
You got to hold it longer. It's not exactly going to help your returns if you're focused on IRR. You got to deal with brands. That's actually kind of the fundamental biggest thing. As these assets get older, but particularly limited service, the PIPs are just getting bigger and bigger and bigger. And we've all talked about it a lot. But if you start to bump up against a second renovation while you've owned a hotel, you're basically wiping out your profits, right? You underwrote 1 PIP, you probably didn't underwrite 2.
Right. People have been, shocked. Say you haven't been in the transaction market for a while. You've owned a Courtyard for 17 years. It's a great box, good location, probably can get another 15-year license. That old school guy thinks, hey, it's $15,000 a key.
Yeah.
Pricing comes back at $46,000.
Yeah, and even if he was going to have to do it twice.
Right.
And the 4% reserve, what we've all known for years, is not going to cover that second renovation.
Right.
So the answer is if you do that math, you bake into account the cost of the financing, the longer hold period, the ramp up time for the renovation, and the potential cost of it, just sell.
We got a brand guy up here, so let's pick on him. PIPs are a huge driving factor today, both on a decision making. I'm going to sell conversations today. I've got a PIP looming. The brand's coming at me, really pressuring me to do this. How are you guys taking your approach with working with owners from a PIP perspective, both in their owned current portfolio, current franchisees with their individual assets, but also coming to you saying, hey, I've got this acquisition on the table. How can you help me make this pencil?
Yeah, as I was mentioning earlier, David, the conversion, we've actually, even though transaction volume is slower, we've actually had more activity in terms of executions, openings over the last couple of years, and a couple of reasons for that. One of them is flexibility, which a lot of us mentioned around it, right? When you are facing a large PIP, everything we do is with the owner ROI in mind. So when we're looking at CapEx, we want to make sure it's the right, whatever we're asking. A PIP isn't necessary, right? You got to balance the guest experience with the owner, the owner capital. So it's not something we take lightly. But when we do take it's not a one-size-fits-all approach. We do have brand standards, we do have brand-defining elements that are going to be required in there. But if your case goods look good, but it's been 7 years, we're not going to say you have to change the case goods in there. We've always prided ourselves on that flexibility, and that is a big reason for why we've had some of the brands that were mentioned. We were able to convert some of those hotels and reposition those hotels where they're still doing great, but relative to spending $46,000 for the PIP, as you said, maybe you spend $15,000 on the PIP, and you're maintaining for that asset, the performance is appropriate, and you're doing well in that. So it's really working with the owners to make sure that the PIP is right, and sometimes it's not just taking everything away from the PIP, right? It's giving them a little bit more time to complete the PIP. As you're transitioning there are going to be items we're going to require before you open. There's items that could wait 24 months, the case goods example. So and that's not something we're only doing post-COVID. We're seeing a lot more conversion activity, and we've been net beneficiaries. So we're seeing that, but we've always done that even before.
And it can depend on the brand too.
Yeah.
I was talking with an owner the other day that owned a extended stay hotel that was doing very well, and there was a lot of very long-term guests in there. And those guests didn't want him in his room or their room, did not want them to come in, maybe change my mattress.
Yeah.
But then there's 20, probably 30 rooms that were very transient that they can get higher rates for. So we'll do the full PIP in those.
Yeah,
Put in the new kitchens, we'll do all that.
New York
but-
City is a great market where you're doing right now, demand, like you guys have a lot of inventory. Demand is really, really strong. We're not going to ask you to take out half your inventory out to renovate and you're losing out on that, right? We're going to be there. It's going to be a much more staggered renovation as you have maybe some down periods you're renovating, whereas in a market where it's seasonal and you're running 30% occupancy, that's the great time for you to do all the renovation. You brought up extended stay, and we're just talking about capital recycling. One thing that everyone has whether it's your basis or a price expectation in mind, but there's a lot of variables going into it. Like how long are you going to hold it? How long are you going to recoup the? We've seen a lot of institutional folks here, but even within individual owners. We've seen owners who have had select service assets where I don't necessarily, I may have a price expectation here, but this is where the market is. But I'm going to take those proceeds and recycle it into a new construction extended stay brand where I can get those mid-teens returns. I can create some alpha. So we're starting to see that with individual owners. Our Echo brand, we've seen great success where people are moving away from certain segments or they're recycling that capital still within hospitality, but in a brand where they can create more value, where there's more demand for it.
Mm-hmm. We'll get to Q&A here in a little bit, but one question I get a lot from owners, and a lot of times this comes when we get a PIP in the door and they price it out and it's huge, or buyers price it out and they're telling them it's $46,000 a key or whatever it is. Seller's like, oh no, I can do that for less. I'll do the PIP and then I'll sell. Curious to hear your thoughts on that logic. If they should not, how do you guys think about that? Matt, maybe I'll let you run with that.
I think it's probably the right intuition for them to go try to do it. It brings a lot of challenges. How are you going to get the capital? Strains the returns. It sounds a lot easier than it actually is.
Yeah.
But if you can go execute that and then deliver the asset PIP free, I do think that's probably more efficient. But I think it's easier.
But are you ready to hold it for it to stabilize again? And then
If it doesn't transact, then you're back in for another.
And then are they going to have a new color scheme?
Correct.
Always gonna
Blue
be
is out, red is in type of deal. So it sounds good. I think it's tough to execute. And it's only furthering that bid-ask spread right now.
Right.
Sellers are asking to underwrite to perfection and buyers just aren't doing that. And then the PIP comes over the top. And
Look at tariffs. Is it going to be 25% more? Is it going to be 50% more? There's questions. I found it interesting. I was at a Marriott conference last week, and they told me of the 4,000 Marriott limited service hotels in their universe, 3,000 were either due for renovation now or past due. So it is, brands and owners aren't exactly their interests aren't aligned. But what is aligned is they want the product to be improved. And there are 3,000 Marriott hotels out there that need a PIP. So you have to, I'm encouraged to hear Amit talk about it in a more constructive way. If they made the PIP less penal and were more constructive about it, incentivize me as the new capital to come in there, put fresh dollars to work and dollars the asset.
Impactful dollars.
They get a better
A1
product,
impactful dollars.
the guests see it, their brand scores improve, and the deal gets done. So try and position a PIP not as much as a penal thing and throw all the kitchen sink in there, the tub, the showers, the new closets at this Residence Inn concept with the chest that costs $5,000 a key. Incentivize me as the new buyer. It's hey, if you come in and do this renovation in 12 or 18 months, maybe you can push off some stuff to the next cycle. So you don't have to go spend that money. But almost think of it more as an incentive. Is it the carrot or the stick? There are ways that I think brands could help us as owners to get some of this stuff across the finish line.
they just view it as their one opportunity for the next
Yes.
decade. They're going to get everything they want in there, and they're just slowing that
But it's
cycle down.
that's very it's the mindset is too focused on that deal and that asset, and they have to think about the bigger picture.
Agreed.
The limited service sub $20 million market is very healthy.
Everyone talks about the bid-ask spread too. Oftentimes the bid-ask, when we run a process and we get to the finish line, we're off by 10, 12 a key. And oftentimes that's the PIP.
Yeah, and I don't disagree with what Joe's saying about PIPs are definitely more expensive for all of the reasons that everybody knows. I think after some time now, brands are indicating willingness to be more flexible about, avoiding that one-size-fits-all approach going forward, and tailoring PIPs to markets and performance and guest feedback. So we're getting there. It's been a long road.
Right.
The
least they're saying it.
proof is in the pudding.
Like they're saying
Right.
it. Yeah.
We
No,
talk
we-
out of both sides of our mouth too, because we all love staying at a
Yeah.
freshly pipped hotel.
This is not something we've been saying after recently. We've always said this, and we've always operated that way. And we have, we really mean it when we say we'll work with the owners, and owner first is our philosophy, and that really is how we operate. So it is no one's going to sit here and say the PIP. It is a delicate balancing act, right? You've got guests on one side, you've got brand standards, you've got owners on the other side. And trying to find the right balance is not always easy. It's not always perfect, but we try to do our best to get there where you're not doing something, and there's multiple levers. Like I said, you can defer it a little bit, you're giving more time, so it's not all at the time the asset is transacting. So we've always done that, and we'll continue to do that.
Great. We've taken all the air out of the room, and everyone's here to learn something. So we've got a few minutes left. I hope you guys have thought about some questions, some Q&A to pick these guys' brains. So they'll be kind of walking around, passing a microphone, but if anybody has any questions, please fire away. Someone's got to have something.
Someone in that corner. There you go.
Back over there.
Yeah.
There you go.
Testing, 1, 2, 3.
We got you.
Yep, so thank you for coming to speak with us. My name is Maria. I'm a Georgia State University student studying real estate and finance. So I would say my question is more specifically for Joe. So you had mentioned earlier that there has been an increase of lending activity, and especially now where we are here in 2025. $500 billion in lending activity, really relative or similar to what was done a couple years ago. But it's interesting that you mentioned that, because just yesterday, one of the speakers mentioned how while yes, there's an increase of lending activity, it doesn't exactly translate to the hospitality finance market bouncing back. So I was wondering, Mr. Joe, if you can paint a picture, what kind of deals are you financing? Because again, to my understanding of just previously having been in the debt space and also as a student, it's not just any kind of financing that an owner, operator, or developer needs, but it's the right kind of financing that pencils a deal in. So I would love if you could paint a picture of what kind of deals that you're seeing that have that readily available financing.
And that you guys should feel free to chime in. I would say, so yes, financing activity is definitely back. It's back in a few ways. If you look at CMBS, is really the best data point. I think there was $26 billion of hotel CMBS origination volume last year. That was 3x what it was the year before, and it was actually the single most in a year since 2007, pre-GFC. The CMBS markets are ripping. I think the first quarter of this year was 2x last year, and last year was already great. So, but those deals, those are really what's driving that is these big single asset, single borrower deals that you're seeing everyone do. We did 3 or 4 of them. Blackstone probably closed 3 or 4 in the last half hour. That's more refis, right? That's not really driving the hospitality transaction market. That's Blackstone refinancing and just getting more term effectively. The bid-ask spread still does need to narrow, but that market being healthy and competitive, and CMBS spreads on this stuff also have come in from SOFR plus 425 or 450 a year ago, and it's probably 325 to 350 today. So that providing a very viable, efficient alternative, and you're to the private credit market, because you're all competing, right? Whether it's CMBS or private credit or regional banks, they're compressing pricing, which is going to help narrow the bid-ask spread, and so you'll start to see more kind of I think limited service deal volume. It was still pretty good though. If you look at just single asset trades, was like plus or minus like 8 billion last year. Pre-COVID, that was kind of like a $6 billion, $7 billion like kind of number. So it was a normal-ish year. It wasn't 22. 22 was, I mean, David was driving like a Ferrari off of his commissions in 22.
Had to sell that one.
It was probably 16 billion that year, but like it's still pretty good, and I think you're gonna see more as like financing like gets better.
What was your 280 over deal? What was the debt yield on that?
That's a good question. It was a 62.5% whatever like LTC. I think the going in debt yield was like a 13.
Yeah.
Pre-PIP.
Yeah.
Post-PIP it was like a 2.
Yeah. I got to call up BMO and beat them up a little bit here, but no, I think that makes sense, and that's. I mean, banks want that cash flow, and it really helps to have a 13 debt yield staring them in the face with fresh capital coming in, and they can look at it and say, okay, we're in a pretty good spot. So that's how you compress those spreads.
You mentioned CMBS too. It's always, I find hilarious the love-hate with it over time, right? Coming out of COVID, I will never do another CMBS loan ever again. Don't take my calls. I can't get in touch with anyone.
But it
It's
is for
looking pretty good.
For large loans, SASB and large portfolios, that is the most efficient form of financing.
Absolutely.
But there's a lot of hotel owners, individual hotel owners portfolio in here. Even there, I think you're starting to see a lot of positive signs, right? Community banks, regional lenders are still lending pretty actively. It is a relationship-based business, so if you have a good relationship and a track record, you can get the finance. It's not where it was post-COVID, but you are getting it. It's pretty competitive if you look at it on the long term. Like you're not going to get the 3 to 4%, but we are seeing borrowers who are borrowing fixed rate, 70% loan to cost on new construction financing. But they're ones where they have a good track record. They know the bank. They've repaid the bank a couple times. They've recycled that capital. So it is to answer your question. It is if you're first time you're coming in and you're trying to borrow a construction loan, it's more difficult than it was in the past. If you're seasoned, the markets are back. You're probably paying more than you'd like, but I think it's in a positive trajectory.
Anyone else? Yeah, right here.
Inside your organization, are you opportunistic in selecting potential acquisitions, or is there a strategic kind of process that you lay out in terms of markets or segments, or however that may go?
So if you couldn't hear, the question was, are you opportunistic or more strategic in a platform kind of perspective as you look at
I'll take that to start off. I mean, it's all of the above. We have a strategic playbook that we're trying to live by, but sometimes you're beholden to the opportunities that are there, and then it becomes more of a tactical game, fighting the individual battles. So it's any and all of the above. But for us, fundamentally, as I came back to at the beginning, we're trying to find markets themselves first that have above average growth potential, and then dialing down on the submarkets within those markets that have even better potential, because we all know no submarket is the same as any other submarket. So we're a very data-driven approach. We are in almost 100 markets today, so we have expertise in some existing markets as well. And so it's taking all of that data and using it to the best of our abilities. But it's a mixed bag of how we approach those things.
Yep. It's highly scientific. Red states in the South.
Yeah.
I mean, call a spade a spade.
Based in New York.
Yeah.
Yeah, from a brand perspective, it's a little bit more strategic. I mean, obviously we're opportunistic as well, but we're planning for where the next trend is, where it is. So for extended stay, we've really doubled down on that. We've added some new brands. We've done new construction, conversion, and the like. So, but at the same time, we're seeing more opportunity in upscale from some of the reasons where there's too much inventory from a particular brand. We are underpenetrated where we can do that. So that's more tactical, opportunistic, and then there's more strategic. So it's a combination.
Yep.
Follow to that. How do you convince your prospects and your franchisees that simply by adding more brands in a particular segment, you're not sort of diluting the overall strength of the system or the franchisees in a particular brand? How do you get persuaded?
Yeah, I mean, A good question. Fundamentally, as we've talked about, supply is historically low, demand's outpacing supply. So some of the inventory that is coming in is to keep up with the supply, to keep up with the demand, right? So supply is like at 1%, historically it's even below, and probably for the next couple of years it's even going to be. So some of that addition is because of that. Two, there is demographic changes. What I want in a hotel is very different from what people who are another generation below or 10 years younger than me. Like I prefer larger rooms. I like that. There's others who prefer a very different lobby space where they can sit, work, and that. So a lot of the times that when we're adding brands, whether it be a more on the lifestyle side or an extended stay, it is for a different demographic. I'm not saying there's no overlap between the two, but consumer preferences are evolving with different age groups. So a lot of that is to address that, as well as some of the supply demand imbalance so you're adding to the market. So you're not just going into any market, and we don't, adding a hotel, as I said, you need multiple demand generators. So owners are very sophisticated. They're not just going to put a hotel just for the sake of putting a hotel because we're telling them to. They've got to see the value there. And usually when they're looking at a different brand, that's because they feel there's a niche that will be attracted to it. And it's not just a niche, but over a long term, that demand for that particular product is increasing.
That's all the time we have. I'm going to go down the line real fast. 2025 transactions, up or down from last year? Go.
Up.
I'd say flat.
Colin?
I'm going to go flat also.
I'll say up.
Because we're going to sell everything you got?
Yeah.
Definitely not down. No one's saying down on the
saying
Ferrari.
Thank you all for being here. Enjoy the rest of the conference. Thank you.